Hi guys, welcome back to another video. I've had many requests over the last few weeks to do a video about how I pick which stocks to invest in. Quite a few people who watch my videos are beginners to the stock market, and I'm making this assumption based on the contact that I get through my emails and stuff like that. So I wanted to share with you what I've learned so far in my journey and the things that I look at to pick a stock, but also enlist the help of a friend who is much better versed at this than I am. Hi Ben.
Hi Anna, and hello to everyone else watching. I'm a stock market investor with a passion for providing education on investing, and I am so grateful for the opportunity to do this video today.
We've made this video together for you, but please do check out his channel. It is absolutely brilliant. I love his videos, the style he makes them in and the way he explains things. Definitely worthwhile checking out his channel. Just so you know, Ben and I are both dividend investors, which means the majority of this analysis will be focused on choosing dividend stocks to invest in. Because this is a video telling you how we pick our stock, I just wanted to make it very clear that neither of us are financial advisors. Any financial decisions you make are your responsibility, and if you are in any doubt, please do consult a certified financial advisor. Personally, I think the first question you need to ask yourself is, how much risk do you want to take with each investment? It is worth remembering that any investments you make do put your money at risk. Please don't ever forget that. Of course, there are investments that are a little bit safer, but nothing is ever 100% guaranteed. As mentioned in the disclaimer, if you don't feel comfortable making these decisions yourself, please do talk to a qualified financial advisor. And I mean a proper financial advisor, not a money coach from Instagram. Don't get me wrong, I have nothing against money coaches and things like that, but they should not be telling you which stocks you should be investing in. That should be completely your decision, and there is a difference between someone offering you their opinion and someone giving you actual advice based on your risk tolerance and your own individual circumstances. If you want to stay super safe, it is worth sticking to ETFs. That way your money is already spread across a basket of stocks and therefore safer if one individual company should collapse. In my own portfolio, it's a mixture of ETFs and individual stocks. I've personally chosen to invest in the ETFs that track the S&P 500, which are the largest companies in America, and the FTSE 100, which are the largest companies in the United Kingdom. You can also choose an ETF that follows a particular sector. So for example, you could invest in an ETF that follows technology or something like that. The rest of this video will focus on choosing individual stocks should you wish to do so.
Number 2, when I invest in a company, I always look at the growth rate and valuation. When I talk about growth, I'm talking about how quickly the company is growing its earnings, free cash flow, sales, and book value or assets. I want to see that company is making more and more money and becoming more valuable. How fast the growth needs to be really depends on a lot of factors. For example, how fast are the rivals of the company and the company's industry growing? If most companies in the industry are growing at 5% annually and this company is growing at 15%, that is excellent. I want to see the company has consistently grown over time, and I also look at how it grew during prior recessions. Regarding valuation, I look at the price of the company compared to their earnings, book value, free cash flow, sales, and EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Basically, I want to get as much of these things as I can for every dollar I invest. A low price to earnings ratio, for example, means I'm getting more earnings from the company for every dollar I invest. The price to earnings ratio is literally the price divided by earnings. If a company's shares are selling for $10 and the company's earnings are $1 per share, the price to earnings ratio is 10 divided by 1 or 10. I have an entire video explaining the price to earnings ratio if you want to learn more, and it is linked in the description below. In short, I would rather get $2 in earnings per year for a $10 investment than only 50 cents in earnings. How high or low I want these ratios to be will depend on that company's historical valuation, the valuation of its rivals in industry, and the expected growth of the company.
The third thing is dividend cover and payout ratio. I've banded these together because they're sort of the same thing. Dividend cover tells you how many times the company can pay its current level of dividend. So essentially tells you how sustainable the current dividend is. Generally speaking, you would want to see a dividend cover of about 2 or more, as that's what's considered safe in the financial industry. Anything lower than that, and it could mean that the company will struggle to pay its dividend in a tougher trading year. The higher the cover, the more unlikely it is that the dividend will fall in any following year. Now that's important if you are looking to invest in sustainable dividends that you want to use to fuel your FIRE journey. Also, if the dividend cover is less than 1, this could mean that the company is actually borrowing funds to pay its dividends, which is a huge red flag. So most trading platforms and websites will now calculate the dividend cover for you. However, dividend cover is calculated as profit after tax minus the dividend paid on preference shares, or divided by dividend paid to ordinary shareholders. This sort of stuff just gives me bad flashbacks to when I was training to be an accountant. A different way of looking at this is to look at the stock's payout ratio. This basically tells you how much of the company's income is going towards paying its dividends. This is worth comparing to similar companies in the same industry. So if a payout ratio is too high, that means the company is putting most of its income into paying dividends. That might seem like a good thing, but it just means that the company doesn't have much to reinvest in itself. If the payout ratio is over 100, again, this will mean that the company is likely to be going into debt to pay its dividends. Again, a big red flag. A good example of a stock that would have a high payout ratio is a REIT. They are actually mandated to pay 90% of their income as dividends. I've actually just done a video about REITs versus rental income with Ben, so if you want to check that out, go to his channel to have a look.
Next, we have dividends. I'm a dividend growth investor, and thus dividend yield and growth are very important to me. I want to invest in companies which are paying out a decent amount every month or quarter in dividends, but are also growing those dividends quickly. As the dividend payments are increased by the companies and I reinvest them, my returns compound rapidly. One metric that combines both the dividend yield and dividend growth is the CHOWDER number. The CHOWDER number is simply the sum of the current dividend yield plus the 5-year annual dividend growth rate. If the dividend yield is under 3%, we ideally want the dividend growth rate to be at least 12%, which would give us a CHOWDER number of 15, given 3 plus 12 equals 15. If the dividend yield is greater than 3%, we should expect slower growth. We therefore want to see a CHOWDER number of at least 12. We are willing to accept a slower growth rate because we are receiving a higher dividend yield. So, as an example, a 5% yield which grows at 2% is a CHOWDER number of 7, and it's too low for an investment. A company with a 4% yield which is growing at 9% has a CHOWDER number of 13 and meets our criterion.
So the fifth thing is personal interest in the company. Now, you might not see this in your standard what to look out for when choosing your stock videos, but for me, one of the things I look for when deciding on whether to invest in a stock is generally my personal interest in the company. Don't get me wrong, I have mostly invested in companies that I don't have much personal interest in, but I know cover me in all the other areas and are likely to do well. This just gives me the peace of mind that the majority of my portfolio is covered and I'm happy that I think it will do well. But there are some stocks that I invest in them just purely because I think they will do well. I don't really even look at any of those metrics. I just purely believe in the company. Of course, this is a much bigger risk. If you've watched my free trade video, you'll see that I've invested in a company called Greggs. This is a bakery chain in the UK, and I just absolutely fell in love with their vegan sausage rolls, and then they came out with the vegan steak bake, and generally their profits kept growing and growing because these items were such a hit, and they were gonna, pre all of the stuff that's recently happened, they were gonna bring out a new vegan range as well. So I just really believed in them, so I decided to invest in them without even checking any of the other things. Again, I am not recommending that you do this, especially if you aren't comfortable with taking big risks in your portfolio. But for me, I'm personally okay with taking that risk, and I just want to be really transparent about how I invest in my stocks.
For number 6, I always consider a company's liabilities or debt. A company with too much debt may be unable to pay for it. If a company cannot pay for its debt, it may have to sell off part of the company, issue more shares, which drops the share price, and/or go into bankruptcy. These options are all bad for us as the shareholders and will hurt our long-term returns. I would prefer companies I invest in can pay out their cash to shareholders or reinvest that money back into the company rather than paying off interest. I look for companies with low debt when compared to assets and equity. I make sure the company I invest in can pay for its debt and the interest, and I check whether that company's debt has been increasing or decreasing. I want to buy companies which are reducing their debt over time.
Number 7 is a moat. This is a really important thing to consider when investing in a company. Think of a traditional moat. It's what protects a castle from intruders. Well, a moat in the investing world essentially means the long-term competitive advantage that a company has against its competitors. There is no formula to calculate these, but it should be really obvious if a company has a moat in a particular area. For example, think about Google. Do you really see anyone overtaking Google anytime soon? I personally don't. Things to consider are, is it the only company that can provide a particular service? Does it have a particular brand advantage that allows it to charge more for its services? Does it have patents that mean that other competitors can't replicate the very thing that is bringing them the most profits? For example, drug companies. Or a company that has huge economies of scale, as this will allow it to bring down its costs significantly over its competitors.
It is important that we only invest in companies that we can understand. If you invest in a company that specializes in acquisition, recapitalization, mezzanine debt, restructurings, rescue financing, and leveraged buyout transactions of middle market companies, Do you have any idea what that means? If the Fed raises interest rates, is that going to be good for your company? If you hear the market price of securities issued by your investment have increased, is that a good thing? Is it bad? If you can't answer those questions, that's probably not a company you should invest in. It's too complicated and you're unfamiliar. If you are better able to understand what McDonald's does, then that might be a better investment for you because you can more easily predict it, understand why the price is rising or falling, and ultimately decide when to buy or sell.
Let us know in the comments below what you look for when deciding to invest in a stock. Or if you have any questions at all, please don't forget to subscribe to both of our channels. We will both be creating new content for you every week. Thank you so much for watching. Good luck with your investing. Please keep me updated on your progress. I love hearing it, and see you next time. Bye.